mergers. Several of the cases that we will examine in this course involve either a merger of two companies or the acquisition of one by another. Consequently, we will examine a few concepts of mergers. Some of the material is from the textbook, which discusses historic trends, types of mergers, and market reactions to mergers. In most United States, the law requires when existing shareholders of a target firm are forced to sell their shares, they receive a fair value for their shares. In practice, most acquirers pay a premium on the current market value. Research has found that acquirers pay a premium of 43% over the pre-merger price of the target. When the bid is announced, target shareholders enjoy a gain of 15% on average in the stock price. Why are there mergers and acquisitions? Large synergies are by far the most common justification that bidders give for the premium they pay for a target. Cost reductions and revenue enhancements. Other reasons for mergers include economies of scale and scope, vertical integration, expertise needed, eliminate competition, although antitrust laws may limit that, efficiency gains, tax savings from operating losses, growth, and diversification. Diversification is not a good reason for a merger. Investors can achieve the benefits of diversification themselves by purchasing shares in the two separate firms. You can read details in the textbook. A bidder can use one of two methods to pay for a target, cash or stock. In a cash transaction, the bidder simply pays for the target, including any premium, in cash. Target shareholders will have to pay taxes on their gains if they sell for more than they paid for the stock. In a stock swap transaction, the bidder pays for the target by issuing new stock and giving it to the target shareholders. The bidder offers to swap out target stock and the targets receive acquirer stock. The exchange ratio is the number of bidder shares received in exchange for each target share. A stock swap merger is a positive NPV investment for the acquiring shareholders if the share price of the merged firm exceeds the pre-merger price of the acquiring firm. Let's see that. Let A be the pre-merger value of the acquirer, T be the pre-merger value of the target, and S be the value of the synergies. If the acquirer has N sub A shares outstanding before the merger and issues X new shares to pay for the target, then the acquirer's share position should increase so long as A plus T plus S divided by N sub A plus X is greater than the price of A's stock pre-acquisition. X gives the maximum number of new shares the acquirer can offer and still achieve a positive NPV, which is that X times the price of the stock must be less than the target plus the synergies. You can see the maximum exchange ratio in a takeover problem from the textbook with Sprint's acquisition of Nextel. Sprint could offer up to $41 and 62 cents per share. Once a tender offer is announced, the uncertainty about whether the takeover will succeed adds to the volatility of the stock price. This uncertainty creates an opportunity for investors to speculate on the outcome of the deal. Risk arbitrageurs are traders who, once a takeover offer is announced, speculate on the outcome of the deal. An example of a possible risk arbitrage when HP announced the purchase of Compaq is on the next two slides, HP being Hewlett Packard. Who gets the value from a takeover? Evidence suggests that the premium the acquirer pays is approximately equal to the value it adds, which means the target shareholders ultimately capture the value added by the acquirer. When a large company buys a smaller one, typically after acquisition, the target company will have the same capital structure as the acquiring company, unless you're told something explicitly different in your case. You should assume that the post-merger capital structure will be that of the acquirer. Typically also, the larger company tends to have a better credit rating, so it is appropriate to use the acquiring company's cost of debt in your WACC calculation. The risk of the target, however, may not be the same as that of the acquiring company, so to calculate beta, use comps of the target company, not that of the parent, to correctly reflect the target's risk. So now you have a little background on mergers to help you with your case analysis.